Hey everyone, thanks for joining me for this one. In this video, I'm going to be talking about two stocks that I recently bought in my Wealthsimple portfolio. Here's just a quick overview of my overall portfolio and how we're doing. Both of these stocks that I'm going to be talking about today are actually in the Canadian side of my portfolio that hasn't been doing too hot lately, down 1% in the last month, down 3% in the last 3 months. Still not doing too bad overall, up about 5%. But these two stocks, in my opinion, got to really attractive valuations. I'm going to be going through the stocks today. I'm going to be going through a bit more background and business overview of these companies before talking about just what their price to earnings look like and why I'm buying each of these stocks. So we'll just jump into the first stock here. And I'm going to just move over to the Google Finance chart because it's a bit more flexible. But the first stock, as you can see on the screen, is the Bank of Nova Scotia. I'm going to refer to them as Scotiabank for the rest of the video. Scotiabank has a $76 billion market cap here, and they're trading at under 10 times trailing earnings. That's putting them at a dividend yield of about 6.6%. You see on the screen they're down over 20% in the last year. But if I was to put that over a longer period of time, you can see since the year 2000, they've generally done a really good job of creating shareholder return over time in addition to the dividend. And I wish I had the chart up, but in the last 50 years, they've increased their dividend the vast majority of years that they've been operating as a public company over the last 50 years at least. So this is a stock that at a 6.6% entry yield, just at surface level, looks like a great opportunity to get a historically great stock in a great segment of the economy for a discounted price. But we're going to take a bit of a deeper look into this one. Then I'll talk about why I ultimately invested in Scotiabank more today. This is just the investor fact sheet. I'm just going to skim through this quick. One of the charts I like showing on Scotiabank, just to get everyone grounded with the company, is the reported earnings by business line. So you can see almost 50% of their earnings comes from Canadian banking. So this is commercial banking in Canada and Canadian mortgages, so on and so forth. That's almost half the business. About a quarter of the business is international banking. So that's lots of the banks that they own and presence that they own in Latin America. Then they also have global banking and markets, some international work they do there. And then 14% is wealth management. And this has been an area they've been trying to grow more in. I think they've been feeling out some acquisitions over the last 5-10 years, but that's another diversifier for the company. But with that being said, when you operate in different business lines, you do tend to get some level of volatility on some of them, and we'll talk about that in a few slides. This is just a bit of an overview. The company made over $2 billion in Q2, $2.1 billion. You see from year over year, down 21%, quarter over quarter, up 20%. So a lot of movement in earnings here. Just on the quarter, made about $1.69 in earnings per share. So on pace, if I just annualize that, to make about $7 a year, which would put them at that 9.5 times earnings that they're trading for on a trailing basis. You see here that the PCL, which is provision for credit loans, essentially writing off a percentage of loans that they've made, has increased pretty dramatically, up 24 basis points year over year, so up 13 from 13 basis points up to 37. That's a huge jump in provision for credit loans. And the thing about PCL is this is just a forecast. One of the things that happened with all the Canadian banks during 2020 is they increased their provision for credit loans up huge, but it's not a cash flow issue. It's just them saying the economy may have some pressures with interest rates this high. If some of our loans don't get paid back, we're just going to put some of it aside in order to pay for those loans. And then in 2021, when all of the loans did get paid, no one really defaulted to any great degree. The company had to bring back that profit back into their forecasts, and it just blew up the EPS. So something similar could happen here if the economy doesn't go into a bit of a downdraft. But just wanted to clarify that on the $1.69, one of the biggest drops from a year ago has been PCL as we go through the slides. So first, Canadian banking, biggest division, $1.1 billion, so about half of their total net income, just a bit less, down 10% versus a year ago. You can see they kind of quote higher provision for credit loans as one of the reasons for that. So I found that interesting. We'll keep that in mind and talk about that in a couple of minutes as well. Global wealth management down double digits as well. They allude to just some weakness in certain equities, certain markets that they do have wealth management in, specifically Canadian wealth down about 17%. International up 19%. So obviously Canada is the bigger business, but nice to see at least one bright point in in these earnings and these numbers, which are generally down. And then as we look, or let me just wrap up the different business units they have here. Global banking and markets, they call out PCLs again in terms of the net income dropping. And then lastly, international businesses here, they have inline revenue or inline income rather versus year ago on higher revenue. PCLs here though as well, wow, up 49%. So PCL and provision for credit loans across the board were a huge factor in their EPS becoming considerably lower than a year ago. And that's just something that is maybe a bit conservative depending on how the economy goes. So I like how they're protecting for it, but it may enable a surprise to the upside on further EPS guidance throughout the year. This is just to show that I know it was a bit gloomy to see net income on the different divisions down anywhere from 10 to 15% on 3 out of the 4 major divisions, but the underlying fundamental business is generally healthy here. It's really just the PCLs that are being written down. You can see here on Canadian banking up 8%, international up 8%. Global wealth management was down as fee revenue went down behind lower performance, and global banking also up 7%. So generally the businesses that are a bit less volatile were all up high single digits, which was good to see in an environment where there's lots of wage inflation, expenses are going up, other costs are being incurred. So at least on the top line, they are driving a lot of growth. And there's a couple other areas of even further outperformance if you were to go into some of the specifics here, with business banking up 13% in Canada and some other focus areas that they have. Going into some of their provisions that they've made, you can kind of just see here in terms of some of the areas that they're not writing off, but putting aside money more so for some risk. You can see mortgages are essentially nothing, but some of these other areas of lending like auto loans, credit cards, lines of credits, etc., they're showing like just basis point averages that they're writing off here. So you can see it kind of expanding versus year ago and versus prior periods on some of these charts, which is what's getting to that suppressed net income that we saw on the prior slide. And then lastly, this was international banking, meant to show this earlier, but I found this interesting just to see how much of the income and the revenues are coming from different regions down in Latin America. They have a big business in Mexico, Chile, Peru, smaller one in Colombia, but it's still there. You can see their return on equity here. So over 20% consistently in Mexico. That means that's a great place for them to continue to invest in. Colombia seems like it's had its challenges. I don't know the exact specifics, but Colombia as well as Chile seem to be underperforming, not having strong return on equity. But in Peru and Mexico, it seems like it's been a pretty good allocation of capital. So we'll keep watching that. We'll see how those businesses perform over time. But as I look at their presence just overall as a bank being pretty pretty developed in Canada, having a lot of cash flow and a bit of a cash cow in that market, having the volatility of the global wealth management business, but when things are doing well, it typically does very well. And then having some of these big bets in Latin America and other business lines that may be a bit volatile, still developing markets, very sensitive to currency, US dollar, recession, stuff like that. So as that over time gets sorted out, I think Scotiabank will have a really interesting and unique value proposition to Canadian investors by having that exposure to Latin America and being one of the top banks in those countries, which if you look at where they play, and I'm not sure if it's on this slide or not, but it is one of the top banks in so many of these regions. No, I'm not sure if it's here. Oh, here it is. Market share, third biggest bank in Chile, fifth biggest bank in Mexico, third biggest in Peru, sixth top bank in Colombia. So really strong businesses in terms of presence in these markets. And as they hopefully continue to grow, become a bit more developed, more reliable, it's a lot of population down there, a lot of consumers looking for banking services. So I think it's a long-term opportunity. In the short term, though, as I just look at the price to earnings, I think they're going to make about $7, give or take, this year. And then next year, closer to $7.50 is the Wall Street estimate. So they're trading at a high 8 multiple at $64. And lots of the hurt in their earnings per share is actually not even cash flow related yet, as those provisions for credit loans hasn't actualized. The defaults haven't actually come yet. They're just being conservative. So it may even end up being a lower multiple than in the 8s, depending on how the loan quality ends up actualizing based off of how the economy plays out here over the medium term. So at an 8 to 9 times multiple, I'm getting over a 6.5% dividend. I'm getting a stock that has done a really good job of compounding over the long term in a market that tends to protect their banks really well in terms of Canada only having 5 or 6 real large banks, and how many consumers are in each of these banks. It would be very doomsday for one of them to have any significant hit on their business that would impact their equities in a huge way, in my opinion. So I think the banks are pretty safe territory. They trade at really low multiples. Scotiabank has a bit of a unique element with the Latin American side of the business, which is potentially pushing the stock down a bit here. But I think long term, hopefully, are good investments, especially with the return on equities they're seeing in Mexico. And for the time being, I'll have some level of faith that they can just turn it around based off their history. And as I wait for that multiple expansion and hopefully revenue and net income growth over time, I'll be getting my 6.6% dividend yield, which may even be growing in value in terms of dividend increases over time. So I'm comfortable adding more to Scotiabank. I bought more stock of Scotiabank this week. The second stock that I bought has been Jamieson Wellness. I've talked about this one a couple times on the channel. The stock's down 27% in the last year. Jamieson Wellness is a consumer goods company. They sell lots of vitamins, supplements, those types of products. Their namesake brand, Jamieson, is huge in the Canadian market, but they've also been expanding in a couple different ways. We'll look at it a bit more on the slides, but they have a business they've been growing in China over the last number of years. They had a recent acquisition of a brand named Theory in the western side of the United States. And then they also sell Jamieson through distributors and some other more niche protein brands and such in Europe as well. The overall company is trading at about $1.1 billion. And as I look at the stock over the last number of years, it got all the way up to the 40s, and their revenue and profits today are significantly higher than they were back then. The company's scaled really well. They've had a growth CAGR on top and bottom line in the double digits, yet this company has just been underperforming a lot from a stock price perspective. It seems like to some degree there were some really high expectations of their growth rate to accelerate even, and we haven't seen that coming out of the pandemic. But overall, the business seems really healthy. We'll take a broader look at the company here. They recently reported second quarter earnings. You can see the Canadian business, which is a huge part of their business, grew 2%. So not impressive growth necessarily, but at least it's been stable and doing okay. This was their new acquisition. U-Theory contributed over $42 million in revenue. That's all incremental just because they didn't have that business in the base. China, which has been a big focus area, they just bought out their distributors there, grew over 20%. And then international revenue declined a couple $1,000,000. This is a lot less strategic than China, the US, and Canada, but still a part of the business that they call out. I think there were some pipeline shipments that happened in the base period that didn't get anniversaried, which was part of the impact there. You can see here some of the comments on gross profits and such. I won't go too much into it just because we have the messiness of the acquisition. Same with the revenue increase of 45 million, but 42 was from the acquisition. So they didn't have tremendous growth in this quarter specifically. They did mention that in the year ago period, there was lots of inventory loading by Canadian retailers on some of their products, and that they had more organic growth than we saw in terms of retail sales and we saw on revenue growth. Just a couple comments here. They made a couple comments on U-Theory in terms of highlights for the quarter, which was the new business they brought. I think U-Theory is a relatively important part of the story here. It's really, it represents their presence in the United States, and however far U-Theory goes is probably going to be telling of how well they're going to be able to leverage U-Theory to test out Jamieson and some of their other brands in the US, which is the biggest vitamin supplement market in the world. So I think U-Theory was an important investment or acquisition, and its performance continues to be really important in terms of leaving that door open and the opportunity for the broader company into the future. So it seems like met revenue expectations, which is an okay start. They had some new products, a new and improved turmeric SKU, which is, I think, U-Theory's hero product. So they said on the earnings call that this has been doing really well so far, and they're excited about it. Another thing I found interesting, stock's down 27% in the last year. They just did a pretty nice dividend increase from 17 cents per quarter to 19 cents, so over 10% there, which just cements that leadership's still bullish on the company, still on target for lots of their medium, long-term deliverables, and they are putting their money where their mouth is by increasing the dividend at 2%. Once again, won't look too much into the financials here, just giving you a breakdown of that 50% growth, the vast majority of it from the US acquisition. But just looking at some other markets here, China, I think they got a bigger share of their revenue from China now that they bought out their distributor, but making over 10 million in revenue on a quarterly basis. So annualized about $40 million a year there. And then they just have a couple puts and calls on the cost side that got EPS on an adjusted basis to 32 cents, which matched year ago on the quarter specifically. Looking at the company's, I meant to do the revenue, so give me a second here. You can see here that the company on a gross profit basis had a pretty big hit. I think this was one time in nature. They had some investments they needed to make on the back end and some implementation costs as well with the new company coming in, which really hurt their profitability for a 3-month period. But at the end of the day, this company's making big moves for the long-term future. So I'm trying not to judge them too much on their profitability over 3 months. The company's trading at 1.1 billion, and on their earnings call, they said that their free cash flow on an annualized basis is expected to be between 85 and 90 million dollars. So trading at about 12 and a half times free cash flow. Out of that 90 million this year, they bought the US acquisition, They bought the Chinese manufacturer, or their Chinese wholesaler rather, and made a couple other investments before paying the dividend. So they have been allocating that primarily to investing back in the business and then also paying a dividend to shareholders. As I look at the company longer term, which is this one here from 2018 to 2022, you can see just the systemic growth: 320 to 350 to 400 to 450 to 550 last year. Now this year they're expecting 650 to 700. Lots of that is the acquisition, but they're painting a medium term plan to get to $1 billion of sales. And if they get to $1 billion of sales, they'll be trading just over a 1x multiple for a leader in a category that has historically been growing really nicely. I was referring to their EPS also growing at a pretty strong CAGR. And you can see that at the bottom here too. 85 cents, up almost 15%, then up another 20%, then up 10%, then up another 10% or so. So they've been growing the bottom line really nicely too. This year they're expecting to do $1.60. So some of that is going to come down in terms of the growth rate, and that's why the stock prices probably got hit. But at $1.60 in EPS on this company, trading for $26, $27, we're talking about a 16, 17 times multiple for a company that's been able to grow their revenue, grow their EPS double digits on average over the last 5 and over the last 10 years. So I think having a below market multiple for a company in a growing category with a strong track record, dividend growth stock that's increased their dividend every year since they came public, I think that the stock market or the market has traded the stock down to a valuable entry point, in my opinion. And that's why I started a position in this stock. I've owned this stock before. I think I bought it during the pandemic in the mid 30s, and then got rid of it when it was over $40. So I timed it pretty well. I think it was a couple things on an earnings call that I didn't fully understand where they were taking the company. The acquisition of U-Theory was not announced yet. They were just talking about wanting to do acquisitions, and it was pretty cloudy. And it was a couple other variables too, and lots of scare about what their relationship in business in China was going to become, as there were some geopolitical tensions. So I thought it was a good time to cash out at the time. But now looking at the company down 30% from where I sold it, and down 20% from where I initially bought it, and seeing that the EPS is higher, the revenue is higher, the medium term growth outlook is the same on a percentage basis, and now they have a strong presence in the US too. I think it's a more attractive buy than it was when I even bought it the first time. So I started a position here. It's a pretty small position. If the stock keeps going down, I'd be happy to add more and build this into a more meaningful position. But was happy to engage on this one. Just some 2023 guidance here. They're expecting another relatively weak growth year on the bottom line here from, or it looks like they actually lowered their guidance from about $1.70 down to $1.60 a share. So I think this is just growth pains as they acquire that new company, as we are on the backdrop of all the COVID growth that they had. But I'm okay with 1 or 2 years of a slowdown as long as we're not going backwards on EPS and we're still driving revenue. If they make the proper investments to get Jamieson into the US and build the China business, I think over time, it won't matter if we do $1.60 or $1.70 this year. If in 2024, 2025, we're doing $1.80 and then $2, and we keep growing that on a 10% CAGR, my 17 times price to earnings that I bought into will slowly turn into a 10 times price to earnings by the end of the decade. So I really am looking at this one from a long-term lens. I think if they play in a category that is just going to grow from here, they have a lot of power and brand equity in that category, and that's why I'm comfortable starting a position acknowledging it can still go down further and willing to build it out even more if that does happen. Also getting a nice 2.8% dividend to wait here. Okay, so those are the two stocks that I've recently bought in my portfolio. I want to thank you guys for sticking around for this video. Let me know your thoughts on these stocks in the comments. And if you like this type of content, be sure to give this video a big thumbs up. It really does help with the channel, and consider subscribing. Thanks a lot, guys. I'll see you in the next one.